Good evening. Today is April 23rd, Friday, and Victor is on vacation. So we have Andy Aiken, who has graciously agreed to join us, and he will be substituting for Victor for today and for Monday. S&P 500 had another reversal day. We have reversed yesterday decline and closed up 40 points. Well, we basically are unchanged for a week after all this up and down action. Economic data was really very positive today, so that affected the markets, as well as people have realized that the scary numbers for the tax plan that has been revealed yesterday are not going to be as scary. They have been downplayed already. The final bill is likely to bring the rate to 28%, not 43% as originally thought, and even more so that the tax rate is going to be affecting only 1% of the population. So it's not going to affect most of the people. At least that's the understanding right now. So the fear has been downplayed and the market has rallied all the way up. Victor talked about the 4150 Soja level, and it was easily breached this morning and exceeded, and we went to trade as high as 4186, making again new highs today. So Victor should be proud, as usual, of his great predictions. But of course, it's not only the predictions, all his wisdom, and I don't want to downplay that as well. And the market sold off 20 points at the end of the day, and this is and closed at 4165 or so. And now, to begin with, we're going to talk a lot about crypto, given that Andy is an expert in crypto. But to begin with, Andy, how do you know Victor?
Sure. Well, I first got to know him in 2012, 13 timeframe, and it was at the NYC Junto, which was a meeting that he ran for over 30 years in New York, and it was a really sort of a speaker series. Toward the end, it sort of diversified in some other types of meetings like Oxford style debates, but for a while it was a kind of speaker series, and there were some very well-known speakers at the meeting over those 35 years, and some like people, for example, like Peter Thiel, who I want to say in like 2004, he came to the meeting and made a pitch that people should invest in the seed stage of Facebook, that he invested something like $500,000 in it himself. And of course, he turned that into 500 million from that one investment. But so that was just an example, but there were some just incredible speakers over that time. I moved to New York in 2012 and got to know him there just by attending regularly. And then when I had some job changes, I worked with Victor. I worked for him, managing a portfolio and providing, let's say, kind of models and guidance during the 2017-2018 timeframe.
Well, Victor is not listening now. Was he a mean boss or was he a fun?
Oh, he's one of the most interesting, unusual people I've ever worked with, and just a really independent thinker, and just brings in any ideas from any number of sources. Just his stack of books that he was going through to read were just incredibly diverse. I mean, everything from art to science to music, and it was just
ecology, biology.
Oh, all just really everything that very, very curious and thirsty for knowledge, and I think also the people that I got to know through Victor, just also very, very unusual, diverse group of people, and I've learned a great deal from him as well as the people in his circle.
Do you trade S&P 500, or do you buy and hold and mostly trade crypto? Or
well, let's see. I would say up until maybe 2017, I traded for 25 years, just really stocks and futures, and that were in traditional markets. And it was maybe in 2016 that I started investing in crypto, and it was really just a small amount. But but because it exploded in value in 2017, it went from being, I think my target was something like, this is going to be 2% of my net worth, and then in less than a year, it went to a much bigger percent. And so I thought, well, this is now, I need to manage it and think about how to manage this money, trade it intelligently. It was, I think in 2017, it was a bit of a bubble. And there might be people that say the same thing about that now, but I think it was definitely in a bubble in 2017, early 2018. It kind of got ahead of itself the same way internet stocks might have in, say, 1999. But this time there's been a lot of development over the past 4 years that may, to a greater extent, justify the value that we see of some of the crypto, not all.
What are some of those developments that justify the value of Bitcoin today versus 4 years ago when you were saying it was bubblish?
Okay, so I break that down into Bitcoin and then let's say Ethereum and some others because I think they're separate cases and the answer is a little bit different for each one. I think with Bitcoin, the main investment thesis is that it's an alternative, a kind of alternative asset. Some people would say it's alternative currency. It could replace the dollar as a reserve currency. That's kind of, it gets into semantics a little bit because it's like, is it a currency? Is it a commodity? Is it just an asset class? I would say it's, my view is it's sort of a hybrid. Bitcoin's a hybrid between being a commodity and a currency. And there's lots of things that could be currencies, like cigarettes might have been a currency after World War II in Germany.
Or prison.
Right, or shells, or copra. These things have all been currency at some point. But it's so I'd say that it's just an alternative asset class, and it has a kind of there are people that say it's this kind of digital gold, and I think there's something to that because there are institutions like Square and MicroStrategy and companies that are actually keeping Bitcoin on their in their treasury as a store of value, and that may be just say 4 or 5 companies in S&P 500 right now or Fortune 500, but it's a very different than what the situation was in 2017, where it was still this kind of just a ragtag kind of shaggy dog asset class that was brand new, and there was a lot of doubt and jokes about it on CNBC and so on. I think now they're sitting up and paying attention. So that's Bitcoin. So I think Bitcoin has, and by the way, also Bitcoin is the largest, the first and the largest by far in terms of market cap. So it's still the dominant cryptocurrency, and it probably will be for a while. But then there's what are called the smart contract platforms like Ethereum, which they have in my view, a totally different value proposition, and that is that you can run instead of just say holding the value and transferring the value and having it be a store of value. That what they allow you to do is write programs, sort of programmatic money that you can program the how you want this value to be stored or manipulated or moved around or lent, and it's all done through what are called smart contracts. And these are instead of being like a legal contract on a piece of paper, it's all in code. And so if you lend someone money at a bank, you sign a contract that says, I'll pay you back over this time, these terms, and so on. Whereas on say Ethereum, it's all in the code. And so because your money's online, it's going to get paid back because it's all coded. It's held in a wallet. It'll, it gets locked into contracts.
Well,
And
that's where I'm lost with the whole Ethereum. I get everything else, but okay, so let's say me and you, we signed a contract, you lend me $1 million and you code it whichever way you want. I'm gonna go spend that $1 million. Now, you still need somebody to enforce it.
Well, okay, so that's another difference between traditional finance and some of these what's called decentralized finance, and that is that in traditional finance, banks are under collateralized, and that's how our financial system works. Like they may have, like under Basel III, they might just have 15, 17% capital cover for all of their loans. And that's how they make money. That's how they're able to be profitable.
Right.
Whereas on these smart contract platforms, by the way, Ethereum's not the only one, it's just the largest one and the first. They're over collateralized. They're over collateralized like 7 to 1. And so you may borrow $1 million, but in order to borrow that $1 million, you'd have to deposit $6 million to borrow that $1 million. And then so your collateral could fall in value, but then even things like liquidations, it's all built into the code. And so it's all programmatic. And
so Ethereum would be the one holding my collateral?
Well, you're actually holding so this is where it gets a little,
it does.
Maybe it takes a little time to grasp it, that you're still holding your collateral, and you get the loan, you're still holding your collateral, but your collateral is locked in a contract, and you're still holding it. It's just it's been sort of encumbered by this contract, and in order to unlock it, you have to meet the terms. You have to pay back the loan or do something else to satisfy the terms of that contract.
How is it locked? Is it somewhere on the blockchain locked by Ethereum?
It's locked by the program, that the code that's behind. So it's like that. If you it locks it. You're not able to. You still have the asset, but you're not able to move it or give it to somebody else or sell it. But you can. But if you pay back the loan, then you can withdraw, and so at first, the thing that's really caused the explosion of what's called decentralized finance is the rise of what are called stable coins, and that is it's a coin. It's just like any other crypto, except it's tied 1-to-1 to the US dollar or the euro or something like that. And so if you're providing that as collateral, then there's not the collateral risk that there is for something like, if it's something like Ethereum, where it just over the last 2 days, it dropped in value by over 20%. And as you can imagine, there were on some of the exchanges where people are trading on leverage, and even on some of the lending platforms, there were liquidations for people that use that as collateral. But if they're using US dollar backed stablecoin, there wasn't any liquidation. That collateral was stable, at least against dollars in value. So that's caused a kind of revolution in decentralized finance. Is the availability of these stable coins. Because
how are they different from US dollar? Is this simply because they could be recorded on the blockchain and US dollar deposits cannot?
Well, okay, so there are stable coins that are, let's say they are tied one for one to the dollar, so they're always redeemable for $1. So they're backed by a dollar.
Right, but then why not use dollars? I guess that's my question.
Well, because it is dollars, but it's tokenized dollars.
Right, so
it's on the blockchain, basically.
On the blockchain, right.
It's just it's a dollar equivalent.
Mm-hmm.
So there are some that are not, they're not strictly backed by a dollar. They're collateralized, but they're not, there's not like dollars sitting in a bank. And so that's sort of a debate within crypto, which are better, the sort of more decentralized ones are the ones that have bank style backing of the currencies. It's a little bit, maybe for people that are less familiar with crypto, it seems like a kind of pointless debate. But these are the types of things that people, worry about, because what the original idea was, trying to create a trustless financial system. If our entire financial system is based on trust, well, how do you, in a world where trust seems to be breaking down, how do you keep the financial system going?
Well,
And
how
that's,
exactly? Just recently happened in Turkey, I think,
yeah.
was that one of the exchange guys has absconded with all of the tokens or bitcoins or whatever deposits he had. And people don't know where their digital money is now. So it's,
Well, that brings up a very important point, that one of the, what people say that have been around crypto for a long time is, not your keys, not your crypto. And in other words, if you deposit on an exchange, then it's somebody else's. They're managing it for you. Now, it may be convenient, you can trade it at a moment's notice, but if the government comes along and says we're seizing all the assets in your exchange, well, you're lost. And that's happened a number of times. Is it may not be the government, it could just be like a scam. There's a hack, or the exchange turns out to be a scam, like what was called Mt. Gox back in 2014, where it was at the time the biggest Bitcoin exchange, and what today is worth billions of dollars of Bitcoin were stolen, and people are trying to still today get back pennies on the dollar for that Bitcoin. And so it's very risky to keep your these assets on an exchange, where it could be the government could say, well, we're not going to tolerate any payment in crypto anymore, like Turkey, and we're just going to seize everything. Don't worry, we'll give you your value in lira in like a year or two when we
right.
get around to it.
Interesting. And so back to Ethereum, what would you say the most common use for Ethereum contract outside of NFTs? Let's just ignore that for a while.
Outside of what? I'm sorry?
NFTs, those non-fungible tokens.
Oh, sure. Well, so the biggest one is what I was sort of touching on, which is what's called, the term is DeFi, or decentralized finance. And so this, the idea is that is based on lending, and there's also some activities like what are called yield farming, which is a way of getting income yield on cryptocurrency, on either could be stable coins, on Ethereum itself. There's also staking. So Ethereum is moving to a proof of stake system over the next year or so. And so there's already the ability to stake your, or lock up your Ethereum as a signal that you believe in this new system. And as in return for that, you earn a return on it. And it could be a pretty good return, let's say about 10, 11% per annum that you're getting on top of the whatever appreciation you get on crypto. So this is so in essence an entire financial system has that's still in very early stages, is being built on Ethereum, and there are some others that are.
Right. So then what is one Ethereum? I mean, this is not really a currency like Bitcoin. So one Bitcoin is a currency you buy and sell, you could price in Bitcoins. But Ethereum is a smart contract. So what exactly $2,000, whatever it's trading at, is buying you now in Ethereum? Is this, am I buying? I'm sorry, maybe the questions are stupid, but I'm just trying to understand, because Ethereum is one of the things that is very confusing. What is $2,000 of Ethereum buying you?
Well, so
Smart
it's
contract or?
So it's so just like so both Bitcoin and Ethereum are similar in this way, or they're the same in this way, that they're, and you can think of them as essentially vouchers to participate in this financial network. And that the more you have, the more participation that you can have.
Is there a
And
limited
so,
number of Ethereums?
yeah, so there are, there's a maximum of 21 million Bitcoin.
Right.
There's right now about 120 million, say, Ethereum. So there's more Ethereum than even the max of Bitcoin that there can be. But there are some changes that are happening to Ethereum where that number, well, it may actually go down over time. So it may even be slightly deflationary, like 0.25% a year. And then they're moving to a proof of stake system where the amount that you hold is essentially it's a share of the network. And so it will give you voting power and some of these other things. But it's but what the value today is it's what is called gas on the Ethereum network, where it's how you pay for transactions. So all of these transactions, whether it's other tokens or moving stable coins around or investing in these different platforms, you have to pay for all the transactions using Ethereum, and that's what. So it's the transaction currency on this network.
Right. Thank you. Very, very good explanation. I think lots of
Mm-hmm.
people
Mm-hmm.
besides me going to learn a lot today.
Sure.
And just to switch gears a little bit, we'll get back to crypto, because I think you also mentioned that you pay attention to the commodities. And as I'm sure you know, soybeans have been going up, making new highs. Wheat, corn, all the commodities are making new highs. And all of those costs are finally being pushed through into consumer. And Procter and Gamble, Kimberly-Clark, Coca-Cola, they all have publicly announced that they're going to be raising their prices, citing their commodity costs and manufacturing expenses costs. And so I guess a couple of questions. If you think the commodity prices will be continue going up, and if you think inflation is a temporary phenomena as the Fed thing or more of a permanent thing?
Well,
Transitory.
that's the. I think that's the question on everyone's mind right now.
Right.
Uh, I, I'd say that the other thing that I think is behind this is the Biden administration. I think the Trump administration was actually much more union friendly than previous Republican administrations.
Mm-hmm.
But the Biden administration, through things like the PRO Act and some of these other pieces of legislation that they are sponsoring and they're behind and would sign if it passes, they would I think give more bargaining power to unions. And it's not that I'm anti-union, but they have historically been a source of wage push inflation. And so they can, if at the same time that we're seeing commodities prices going up, well, those are the sorts of things that, and then let's say a minimum wage increase. These are things that then, when it comes time for unions to renegotiate, then they were going to negotiate for a much higher pay rate. On the other hand, unions don't have the same bargaining power in our economy that they did, let's say, in the late 70s, when we really had the last wave of wage push inflation. But it is going to affect salaries and wages, and that's when you start to see the consumer prices really go up. When salaries and wages go up, then companies won't have any choice but to raise their prices, because that's going to be the biggest source of their costs, right?
Right.
More than half the costs are
Wages.
salaries and wages, and so they won't have any choice at that point, though. It's either that or start to lose money. So I'd say I don't think there's any way around it right now. It could be. I mean, it could something could change, but the only thing that could change it is if we have some sort of blow up in the economy and it heads into recession. But it seems like everything that both the Fed and on the fiscal side, uh, it's to reflate the economy and to get the economy working again and bring it out of lockdown and so on. And it's going to, we're deliberately reflating and pushing up prices as part of that, I think. So, but I see it continuing. Now the agricultural commodities, it's really interesting to see those rallying. I think it's been at least I was just looking for stocks today that I was that I was trading when we had this last type of inflation with agricultural commodities going up, and a lot of these stocks are gone now, like Potash and Mosaic and so on. They've been either bought out or some sort of business change. But they were great vehicles for trading these things in addition to trading the commodities at one point. But there are stocks like like CF Industries, CF, that it's more of a nitrogen fertilizer play than and so it's a little bit more tilted toward corn and wheat and soybeans, but still, corn is hitting all-time high or multi-year highs right now, and so but as is soybeans. So it's a really interesting to see. Of course, the other commodity that's been rallying very aggressively is lumber, and that it's what's interesting is I saw some commentary this last week that, well, there's reasons for this, and that's things like supply bottlenecks and uncertainty on the part of manufacturers, whether these high prices are going to continue and so on. And if you look at economic history, I mean, inflation doesn't just mean higher prices; it means supply bottlenecks and uncertainty regarding, how much, whether the prices are going to continue and so on. That's exactly how inflation manifests in an economy, and so we're starting to see that replay, I think. And now, whether what does happen though is that eventually, the inflation gets incorporated into the economy if the capacity, production capacity goes up and so on. If it can go up, then the inflation will start to drop. But I think in a lot of these industries, there's just there's not that kind of spare capacity that there was, say, 10, 15 years ago.
Right, and I guess it also will depend on the Congress continuing supplying free money to people without work. I mean, at the end of the day, doesn't it all come down to productivity versus money supply? And
Right.
if the money supply keeps growing while productivity is not, then
Well, and what I think what we see is what's been happening over the past year, which is that it's asset price inflation. So, which is stocks, but then I think also crypto. I think a big driver of the crypto rally over the past year has been, I don't want to say it's not inflation in the
inflation
sense of,
expectations, perhaps.
yeah, it's asset price inflation. It's like the money has to find a home. It's going to go somewhere. It's going to go where the returns are highest, and so it dives into crypto. It dives into where the the speculative vehicle of the moment.
Well, now that we brought it all around back to crypto, everybody wants to know, of course, Bitcoin has dropped like around 25% of the highs and crossed, fell back under the 50 level, which of course famous Soji level, as Victor calls it, and now it rebounded back up. And so everybody wants to know if it's a longer term pause that refreshes, or is it something bigger?
Well, there's it's had a huge run since October, as you see, but I think that to a large extent the price levels that it was at in 2020 or where it went in March of 2020, where it dropped close to 4,000 per Bitcoin. That was a bit of a bear market that overran itself, I think, or became overextended as a bear market, and so the price level that might have been more of a fairer price valuation was probably let's say in the mid, between 10 and 20,000 per Bitcoin, and I'm basing that just on a valuation model that is the size of the network, number of users compared to history, and but what we've seen is over the past year is not just it's a big growth in the number of users and a big growth in the number of holders, and I think it's been more institutional participation in Bitcoin. So I think there's a price support for Bitcoin that at minimum, in my view, around the 45,000 level right now. The fact that it bounced around 48,000, that's been a level that it spent a lot of time in that range, or spent a good amount of time, several weeks in that range, a little bit earlier this year. And so the fact that it bounced around that range and now it's back above 50,000, it didn't surprise me. Now it might make another leg down here, but I would expect to see a bounce around the 45,000 range, unless something, and then have it bounce there. But I think it's still in a bull market right now, and I think that the longer term trend is still up, but there was just this what I think happened. It's not so much a Bitcoin story as it is a crypto story. There are a number of very speculative vehicles that and people call them meme coins because it's more of a meme, like Dogecoin and some of these coins that are they're very speculative. They don't have MicroStrategy investing in them. It's more like Elon Musk tweets, buy Dogecoin, and so there's a huge push in the price, and it's sort of like there's really there's nothing but air beneath these. So there was a lot of this kind of speculative frenzy and a bit of euphoria and mania over the last few weeks, and I see what happened in Bitcoin over the past few days as being a flushing out of some of that excess. And because you've seen something like Dogecoin, it was at one point off more than 60% off its high, where Bitcoin off 25%. Some like Dogecoin or some of these others were off 70, 80%. Right. And the less of that kind of hyper speculation or mania that we have, the better, the more bullish. That's where I think bullishness returns, is when some of that gets flushed out, and then it becomes a little bit more of a sober investment environment. So, but I think the trend is still up in Bitcoin longer term. I think we could see another leg down, though. That might take it down to about 45,000, but then I could see a recovery from that point.
Well, right. Maybe another news headline like there was the other day, people were saying that crypto is going to be taxed at 80%. Obviously, absurd headline, but there could be something real that SEC comes up with to try to tax the profits, which probably will temporarily take a hit to Bitcoin.
Yeah, there was, and then of course the thing that I think was the trigger for Bitcoin was there was a power outage in China, in a specific province in China, where a fair amount of Bitcoin is mined, and it's because the power, it's sort of like in Washington State in the United States, where power is super cheap there because of hydroelectric power and so on, and that's where it's done in China. And when that went out, what's called the hash rate, or the amount of computing power that's put to maintain the Bitcoin network. It dropped something like 40% in just a few hours. And what I think it showed is that there's maybe a bit too much dependence on China to keep Bitcoin going. So it created I think created a little bit of a panic state that then led to the pullback. But then there was this other speculative energy, and then news about the taxes and so on that just sort of fed into a more bearish way of thinking in near term. But I think I could see there being a bit more of a pullback. I could see it bouncing here, but then pulling back this next week and really scaring some people. What I like to see is like Barron's today had a headline that crypto in a bear market, and their definition of bear market is not like lower highs and lower lows, but it's off 20% off its high, which in my mind it's like a kind of brainless.
Right, it has to be based on the returns and volatility.
Right, exactly.
Move in one day almost.
Exactly. So it's like, sure, it's a bear market in the S&P 500 that doesn't have the anything like the volatility of Bitcoin, but I think it's not. They were applying this, but I like seeing those type of headlines because it shows that there's it creates a little bit of fear, and that fear is a good basis for a more bullish market. It's just, but I think we're starting to see that. I think it's still a little bit of too much euphoria that might need to be worked off.
What is the best place, if you know, to buy options on Bitcoin?
Well, so there's a couple ways to do that. Clearly you could buy, if you have a futures account, you can buy options on futures. And so there are Bitcoin futures. They are the Bitcoin futures. A lot of people find them hard to trade because the contract size is like 5 Bitcoin. So it takes a minimum margin requirement. You need something like $170,000, just your margin requirement, which is really unusual for futures, where it's like 50% margin requirement. But the CME did announce, I think today or yesterday, that they're going to have a mini Bitcoin contract. And they haven't said what the size of that will be, but it will probably allow a lot more people to trade the futures than have been able to, just because the contract size will be a lot smaller. But you can trade the options on the futures. So that's, I think,
CME has that, or other exchanges have their own?
Well, okay, then there's a whole set of exchanges and even options exchanges within crypto itself. Some of them would say that they don't allow U.S. investors. There might be people that I don't do this myself because I it's just not something I've done. But there are people that use them, but they have to use a VPN, or there might be people that are based in Europe that they're able to use these, or in say Hong Kong or Japan or whatever, that use them. But some of these exchanges like FTX and Deribit and Binance, these are the ones where they do offer both futures and options on Bitcoin. Then there are some, but a little bit less available to U.S. investors right now, and but it's coming, but it's less of an option because of things like Dodd-Frank that limit the types of they put a regulatory burden on new options products and new futures products and so on, and so that even for Bitcoin, even for Ethereum, so that makes it harder for U.S. investors to access those. But I'd say there are some online exchanges like and one of my favorites is BYDX, where you can trade options on derivatives on Bitcoin and Ethereum. and I've used that one for a couple of years, and it's in my view a great exchange for that, and it's all on chain, on the Ethereum chain.
Thank you. Also, I think you have mentioned that there are certain websites that show you that try to value crypto and Bitcoin in particular, as far as based on the sentiment or some sort of analysis.
Mm-hmm. Yes, and I think those are this is, again, I can show some charts here that I think would be interesting. That let's see, how do I? Here we go. So I'm going to a site called that's called Glassnode, and this site has it is a subscription site, but I use it extensively because I think it allows good tracking of different fundamental underlying fundamental value and sentiment behind crypto like Ethereum and Bitcoin. So maybe I'll start off with Bitcoin. Actually, this is what I'm showing here is a chart that is called the net unrealized profit and loss. And so this is based looking back within, let's say, a 6-month window. What is the net profit position of people that are holding Bitcoin? And so what it's showing is that so there's I think the way to look at this is sort of a less of an absolute number and more of where it is in the range, in the historical range. And so what we've seen here over the last few days is that this net and unrealized profit and loss, or it's declined quite a bit. So the net unrealized profit of people that are holding Bitcoin and have acquired it in the last 6 months, that's declined quite a bit, as we'd expect. But we see if you do the same thing for Ethereum, then you see that it didn't decline quite as much. So it's still at a higher place within its range. And part of the reason for that is that Ethereum didn't fall as much over the last few days as Bitcoin. Bitcoin made a top, I'm going to say, on the 19th. Ethereum actually made a new high yesterday, but then pulled back pulled 20% off that high. But if you look going back a week, it's actually still above that level. But what this is saying is actually, in my view, it's a little bit of maybe a caution sign that there's still a lot of, if the market continues to go down, there are the profit position is still close to a high, and so there could be some risk that people that have a profitable position right now that are traders, they may see it's a good time to cash in, to just get out and go flat again if they're traders. And so this is trying to look at just the trader position. But so this is one way to one thing that I think is important to look at, and a lot of people that manage that are, let's say, some of the institutions that have emerged to manage crypto, that they look at something like this as a sentiment indicator. Another one is what's called the Mbrb ratio, which is the market value to the realized value ratio. And so this one is market value is it's the dollar value in the market, and the realized value is it's a let me make sure to get the statement exactly right here. That it's a kind, what this is kind of ratio of fair value, and so it's the realized capitalization is it's a metric of the network value based on a valuation model that's based on something called Metcalfe's law that tries to get at the network valuation. And so, so what you see here is that this value right now is somewhere in the middle. It's not at a peak. So this is a little bit more of kind of a fair value metric, and it's saying, well, we're more in the middle of the range of fair value. And if we look at Bitcoin, then you see it's get the same one. So you see we're actually, if you again, this is looking back. Let's see how many days to the beginning of the year. So we're actually toward, we're in the lower part of that range if we look at this fair value metric. So Bitcoin may be, at least from the standpoint of this kind of sentiment metric, it's a little bit, it may be pushed a little bit much compared to its historic fair value ratio, at least over the last year. We could look, we could go back more time than this. Let's see if I can move this time frame here. Go back to, you take it back like a year here. So this is a really nice site, and I do recommend it for people that are interested in really combining their or bringing these types of sentiment metrics or fundamental metrics into their trading. If they're trading crypto, then I do think this is a good site to look at. They do a really nice job of compiling the data. It's not cheap. So the one I get is sort of the what's called the pro level, which is maybe $300 a year, but there's a level that's higher, institutional level, that's quite a bit more expensive. But this shows that, well, so of course we're at a relatively high level because compared to the previous year, but I think that in a way it was pushed down by the same bear that pushed stocks down because of COVID. But then we've seen this this big rally here, and then it's sort of consolidated over the last few months. So the question is whether I think that if it starts pushing to new highs, then that might be a kind of a caution sign. But if it stays in this range that we've seen over the last 3-4 months, then I think that it's a more of a supportable value. So it's so these are some of the things there, but there are a lot more statistics. I'm just showing a few things to look at, and there's a lot of different data sources here. Things like one of the things that people look at when we've had a big pullback. I want to see if it's here. Is long liquidations. So these are futures that are not the CME futures, but the exchange-based futures that I was referring to, where you've seen here, and it looks like this is a newer data source. So this is there's less data here. Let me see if I can fix my screen here. But what's probably not surprising is that we've seen a big spike in liquidations here. We had this line, or this looks like this is a sort of a 7-day moving average, but we had a lot of liquidations, and then they looks like here that that's tapered off a bit because the big push down in Bitcoin was actually over the last from the 17th. The 17th, and now we're starting to see a decline in the liquidations, and then there are short liquidations that you can look at too. And I think these can indicate maybe a potential turning point in the market that we're starting to see now. Of course, a decline in short liquidations because there's been a big move down. So there's a lot more information here as well, but these are some things that I find interesting to look at, and they can indicate a potential reversal, either on the long side or the short side.
Thank you. That's very interesting. I haven't seen the site before. Definitely worth checking. Wow. Well, I think we have downloaded our viewers with so much information. Thank you. And I have a lot more questions, but let's save them for Monday because I'm sure I've
Sounds great.
exhausted you with all of those questions. But if you want to add anything in particular about Bitcoin or the markets or something we haven't talked about.
Well, the one thing that I think is, where Vic has made a lot of interesting commentary, and I think he's been very right on this, is that there are a lot of people who see the rise of this, like thinking of like rhetoric that's anti-market and anti-free market as being something that will threaten stocks or be very bearish. And he's been pretty consistent in saying, no, it's almost like that the rhetoric is a cover for allowing the market to rally higher and hit new highs and so on. And that's exactly what we're seeing. And so I think it's sort of being able to maintain position and not get scared out of these positions from just based on the rhetoric that's designed to scare people out of the market. One of the things that Vic talks about in Education of a Speculator, and I heard extensively from him and working with them, is that markets are they try to deceive people into giving their money away, and so it's that's the issue, is that the more when we see these headlines of 80% tax rate on crypto, or that we're China is this single point of failure for Bitcoin and so on, that these types of things they're almost put out there to scare people out of positions that they'd be better off just holding through and waiting to see what happens.
Right, but I guess many people are so leveraged that they have no choice but to be liquidated by the exchanges.
That's right.
That's causing even more liquidation via the cascading effect.
That's a very good point, and I think that that's the double-edged sword of leverage, right? Is that it can be your friend, and on some of these exchanges that are ex-US, you can literally get 100 to 1 leverage, or 50 to 1, 100 to 1 leverage, like a Forex account, a spot Forex account. But the volatility is 10 times what Forex volatility is. So you can make, if your timing is perfect, then you can make an incredible amount of money in a very short time. But then the chances are that that's all going to be taken away from you at some point, just because of the hubris that builds up. So I would just say my suggestion is to think about keeping leverage. If you're going to leverage, be very selective about it, and don't use more than, say, 3 to 1 or 4 to 1 leverage on assets as volatile as crypto. But that's worked for me, at least.
No, that's a very good advice. But how do those exchanges collect the losses from the people? They're not even based in US. So if somebody buys crypto with a 20 leverage, and then the crypto, Bitcoin or whatever, all of a sudden drops, even if they liquidate you, they could liquidate you because there are no bids in the market. You can end up with hundreds of thousands of losses. And
that's
doesn't go bankrupt itself because it can collect.
Well, that's an interesting story in itself. Okay, so that's a little bit of something that's unique about crypto, is that generally it's not the exchange that's doing the liquidation; it's another trader that's doing the liquidation. And so what I mean by that is that as someone's trade is coming close to risk of liquidation, what other traders can do is they can spot this and say, as soon as the very moment this becomes a liquidatable trade, and that might be, well, it's that all you have left is 1.1 times your collateral. They can liquidate you, and they can get like 8% of that 10%, and the exchange gets 2%. And so they get to profit from liquidating you. The exchange gets a little bit from that, but it's almost like what the exchange is doing is they're delegating the risk management to other traders. They're letting traders profit from liquidation. So there's a huge incentive to liquidate traders that are in that situation.
Very interesting. And so, but the limit orders are common. People place limit orders, or not really?
Oh yeah, it's the same kind of order entry and management system that you have with stocks, or it can be very sophisticated. And then I'd say probably I would say 2/3 to anywhere from 2/3 to 80% of all trades are in fact algorithmic trades that are run by some sort of trading system or bot, if you want to put it that way. But there are some firms that are managing billions of dollars of crypto, and they do it primarily through algorithms and market making, these types of things. So they're the ones that are doing the liquidations too, primarily. Now I could do it if I wanted to, and I'm fast enough, and so on. But it's really the firms that are making the money consistently from that. They're swinging a lot of money in the market, and they're doing it all algorithmically, looking at different exchanges, or they may even be doing arbitrage across exchanges and so on. So it's there's a lot of sophistication that matches what you see in traditional finance.
But the traditional finance is somewhat regulated versus this is not. So is there a concern that some of those exchanges or algorithmic traders have access to, say, order books of the exchange? They know where the stops are. They know when the leverage is at the peak. They know when it's best to hit the sell and then liquidate the traders and pick up the pieces. Like with this recent liquidation, that was pretty much a straight down line and then recovered. And it seems to often happen. And while cryptos benefit or plus considered to be the fact that they're not regulated, at the same time, this particular aspect seems a bit of a disadvantage, at least for small.
That's a great point. And I would say that what you're referring to, where there's this information asymmetry, and a big firm might have access to this information and an ordinary trader might not. I think that's definitely true at some of the, so this is a differentiator is between the centralized exchanges, like a Binance, where they keep their order book closed, or you might be able to see the orders, the sizes of orders, but you don't know who's at risk and things like that. And that's managed separately. But then there are decentralized exchanges where everyone has access to that same order book. And it's just an open book, and everyone can see the liquidation prices for everyone else across the board. So I prefer to trade on those types of exchanges when I can. It might be more expensive because of the fees of doing it on the blockchain, but I have the same information that every other trader does, unlike on some of these centralized exchanges. So that's part of DeFi, or decentralized finance, is the ability that it's transparent and it's open to everyone. So it has some advantages, but what you're talking about, I think, is a real problem. And the other thing, that because these are not regulated, and often these exchanges are in Hong Kong or somewhere else, Cayman Islands or something.
Cayman Islands, right?
There's no like what you have in futures market. If you are spoofing or doing some other thing like that in your trading to deceive other traders, then you can be. I mean, if you're spoofing orders and futures market, you'll probably be contacted by the SEC within.
Well, look what happened to Navarro. What's his name? The guy from London, Navarro's, who is
right, exactly. But I know people personally that they've gotten contacted for doing things like that, and they may not have intended to do it, but they get contacted and asked a bunch of questions and so on. But all that sort of thing is just standard practice. There's all sorts of crazy things happening that would be illegal on in a U.S. if it were a U.S. regulated exchange. So, but that tends not to happen on a decentralized exchange because it's you can see you can see their strategy, what they're doing. You can see it's right out in the open, and so it's a little bit of sunlight can be a good disinfectant, and so I think it's healthy to be in that kind of trading environment. It may be still not regulated, but at least I can see what what everyone else's strategy is.
Right. Is Coinbase centralized or decentralized?
It's centralized, but so it's a little bit of, I would say they are a centralized exchange. It's a regulated exchange though. It's based in the US and they're compliant. Okay, so they're compliant with SEC and so on, and they've tried to work with them to damp down any concerns about a crypto market. So Coinbase and then a few others like Gemini and Kraken they've been trying to let the SEC in to make sure that there are things that are not outright illegal going on those exchanges. And then, of course, they are what the big concern of the federal government is things like money laundering and so on, or people using cryptocurrency to do that. And, well, for that matter, with a regular broker, they might be concerned about that. So that's where like Coinbase has let agencies see enough in order to determine things that they're not doing. That's not going on. But on the other hand, Coinbase has been a pretty good sponsor of decentralized finance too, and they have a lot of what I would call competitors to Coinbase that they allow those tokens to trade on Coinbase. Like Uniswap is an exchange that's decentralized. It's on the Ethereum chain, but so it competes with Coinbase, but they allow the Uniswap token to trade there, and maybe they make money from the trading, but still it's a competitor. But then they have their own wallet, and they've promoted decentralized finance, and then they also have a fairly big venture arm where they invest directly in companies, and they've invested in some of the companies doing these types of things.
All right.
So it's Coinbase gets a lot of people. It's sort of like people hate Coinbase just because they're so big and they are successful, but I think they brought a lot more good than bad to crypto because they have done a lot to legitimize it. And I think the IPO that just happened, it's a huge legitimizer of crypto.
Right, but the stock hasn't been traded well. It's trading below 300. It's been down pretty much almost every day since they opened. It was as high as 430, and now it's about 280. And I guess the main concern I would have is that just because they're first doesn't mean they're last. What makes them special, and why would they keep their pricing power, given that every stock trading went to zero commission Wouldn't that also happen in crypto, that the commission at least will get squeezed, if not zeroed out? If everything is on the blockchain and so forth, you could eliminate the middleman and
Yeah, well, it's I think it's a challenge for any uh, let's say any broker, let's say in the stock market, like say a Charles Schwab, that all of these firms like Schwab or competitors of Schwab, they all have business models where they've tried to move from a pure transaction-based business model to one that, they've got high-touch money management, and they've got these other services, insurance and mortgage loans, and all these other things that are better, more reliable streams of income over time than just transaction volume, which is very closely tied to stock market performance. So it's the same thing. Coinbase, for example, they launched a few years ago custody services for institutions that want to have crypto, and it could be a money management firm. It could be like, for example, MicroStrategy. They have Coinbase managing all of their crypto for them. That yes, the company itself could go out and buy Bitcoin, but then where would they put it? They could put it in a wallet, but then if like somebody um, were to access that or hack it or something like that, there could be a huge amount of compliance issues for that company for not storing it properly. So rather than do it themselves, they turn that over to Coinbase custody, and they'll for a management fee, they'll take care of all of these security issues, all of the compliance issues, and by the way, pretty much every institution that wants to participate in crypto, they'll have to use those somebody's custody services. So Coinbase was the first. There are others that'll compete with that too, but it just comes down to who do you trust, who offers the best suite of services, all these types of things. But so Coinbase is trying to, just like all the other any other financial firm, tried to move from a pure transaction model to one where they've got these other streams of income. And I see that that's where Coinbase, where they probably see their future too, is moving away from that.
so, for example, Coinbase will keep all of the Bitcoin from MicroStrategy in, say, cold wallet, and maybe like a small proportion online, but the rest of it will be offline in some cold storage. But then somebody still has to have the key to access that. So in this scenario, who would hold that key, or would they just share the key so nobody, not one person alone, can access it? Or because
Right. And
the
so
main
that's
point of
called,
failure in crypto is essentially that key. Who?
yep. So that's called, so what they use is what's called a multi-sig wallet, a multi-signature wallet. And then, so not any one single person can access it or spend it. And then then they have these multiple layers of security where they, as you say, they take it completely offline. They're storing it on like a hardware wallet that then is put into a secure facility. And so and they don't even fully disclose all of their security methods for that reason. The other thing that's interesting about Coinbase, and by the way, they're like, I think Gemini does the same thing, is that at least for the retail investor, the crypto is 100% insured. So if there's a hack or something else happens like that, Lloyd's of London insures your crypto with them 100%. And they also have FDIC insurance, just like a bank, so up to 250,000 or whatever. So it's like they're trying to position themselves as like the crypto version of a bank, where it's just as reliable as a bank, but maybe not the hassle of a bank.
Right.
Because I think that's it's like people that are that have used crypto, that have experiences with the traditional finance system. Like, let me just say, like, I had an experience about 6 months ago where I needed to move, let's say, like wire somebody something like $6,000, and I had to go through with this bank, had to go through like 8 different people saying, okay, and what's the purpose of this transfer, and this and that, and it took days in order to wire something like $6,000. But then I've moved many times that in Bitcoin without anybody providing permission, and no sign offs, anything. On the other hand, all those sign offs and all those permissions exist supposedly to protect me. So you don't have those same protections. You have to take responsibility for your security to some degree, and not be you get a text, send 1 Bitcoin, you'll get 2 back, or things that don't make any sense like this. That there are people that get sucked into these types of scams, and unfortunately, there's no way to undo it. Unlike if it were your cash in a bank, they could probably reverse the transaction in that case.
Well, that's the trade-off of the decentralized finance. You have more freedom and you have less protection and more responsibility. That's
right.
It's the trade-off everywhere in life and finance.
Well, that's right. And I think that what the attraction though is you have better returns. So on something like these US dollar-backed stable coins, you're able to get something like anywhere from 13 to 25% annual return, which
Is that
you
because
compare.
they invest them into Bitcoin or other crypto?
Well, you could get maybe on Bitcoin or Ethereum, you might be able to get like, let's say 5 to 10% on, depending on where you go, or maybe even a little bit more.
Talking about the stable coins, how do they provide such high return?
All right. Well, there's a number of strategies that are being used, but the main thing though is that that cryptocurrency is being lent to people. So and so why would people want to borrow a stable coin? It's because they're using it for like margin trading, for example. So they want to borrow dollars so they can buy Bitcoin with it or Ethereum with it, and they're giving you the majority of their interest income from that margin loan.
So the margin rates are that high, the 20% margin loan rates?
Yes, yes. Oh yeah, they sometimes even higher than that, depending on the demand, and so so that's one source. There's also some of these DeFi platforms that they issue their own tokens to the people that deposit there, and they incentivize specific types of deposits. So if you deposit in, so that's the second type, and this is called yield farming, where you collect that token and then you sell it off, and that's the yield. And so there are some platforms that automate this whole process for you. They do the yield farming, and they will sell it for US dollars. And so all you see is that the dollars are accruing in your account. And then the third way that you can earn returns is through what's called liquidity pools, where you're essentially being the market maker for people that want to trade between different types of assets. Like if people want to trade between Ethereum and US dollars, then you can provide liquidity on both sides of that. And you can be the market maker. And so you earn the fee income from that. And the more trading volume there is, the more fee income you can earn. So for the ones where people are trading between stable coins, then there might be very little market risk, but there's the opportunity to earn fee income from that. And so that's where there's really been a lot of growth in the market, is in these liquidity pools and what's called automated market makers, AMMs, and these are a way for people to earn income on their crypto.
Well, Andy, thank you very much. It was a very, very informative discussion, mostly information from you, of course, but thank you again. And I guess we'll continue on Monday.
Great. Have a great weekend, everyone.